What if everything you've been told about investing is about to change? For decades, the advice was simple: buy an index fund and forget about it. But artificial intelligence is rewriting the rules, and the investors who don't adapt are going to get left behind. I'm going to show you exactly what's changing, why it matters, and the 5 strategic moves you need to make. This could be the most important investment video you watch this year. Let's dive in. Before we get started, let me be clear about something. I'm not here to sell you a course. I'm not promoting a get-rich-quick scheme. For decades, there's been one golden rule in investing: buy an S&P 500 index fund and forget about it. It's simple, it's boring, and historically, it's worked incredibly well. The S&P 500 has returned over 10% per year on average for the past several decades. Your money automatically gets split between the top 500 companies in America. You don't need to pick individual stocks. You don't need to be a financial genius. And as the overall market grows, so does your wealth. Millions of people have built serious wealth using exactly this strategy. But here's what's happening now. Artificial intelligence is creating the biggest technological shift since the internet, and it's concentrating risk in ways most investors don't understand. If you're still investing the old way without adjusting for this new reality, you might be walking into a trap. So let's break down exactly what's changing and what you need to do about it. Let me start by showing you something most people don't realize. When you invest in the S&P 500, you think you're diversifying across 500 different companies, right? But here's the reality. For every pound you invest in the S&P 500, roughly 40 pence goes into just 10 companies. 40% of your investment in just 10 companies. Nvidia, Microsoft, Apple, Alphabet, Amazon, Broadcom, Meta, Tesla. Nvidia alone, about 7 to 8 pence of every pound you invest. Now you might be thinking, so what? These are great companies. And you're absolutely right, they are. But here's the problem. They're all betting heavily on the same thing: artificial intelligence. This is what's called concentration risk. Think about it like this. Imagine you're building a house, and you decide to use 10 different builders. Smart move, right? But then you discover all 10 builders are getting their materials from the same supplier, and that supplier is taking on massive debt to expand their operations. That's what's happening with the S&P 500 right now. These companies aren't being valued on what they earn today. They're being valued on what investors hope they'll earn in the future. To justify their current valuations, these AI-focused companies would need to generate around £2 trillion in revenue. That's more than Nvidia, Microsoft, Apple, Amazon, and Meta combined made in their most recent year. A lot of this expansion is being funded by debt. Companies are borrowing billions, sometimes hundreds of billions, to build AI infrastructure. But what if that bet is wrong? This creates a feedback loop. Bigger companies attract more passive investment, which pushes their share prices higher, which makes them take up an even bigger portion of the index, which attracts even more investment from passive investors like us. Round and round it goes. Some analysts argue that if it wasn't for AI spending right now, economic growth would be significantly weaker. So the question becomes, what happens when this cycle slows down or reverses? Now, before you panic and sell everything, don't, because there's a smarter way to handle this. So if the S&P 500 has concentration risk, should you just avoid it completely? No. The S&P 500 is still one of the best investment vehicles ever created. But the key word is rebalancing. There's actually an alternative version of the S&P 500 called an equal-weighted index. It spreads your money equally across all 500 companies. Sounds perfect, right? Well, not quite. When a company starts doing really well, the fund has to sell some of it to keep everything equal. And when a company underperforms, the fund has to buy more of it. You're essentially selling winners and buying losers, just to maintain balance. And it comes with a cost. Those fees eat into your returns over time. With a regular market cap weighted S&P 500 fund, the fund doesn't need to trade as much. Lower trading costs, lower fees, better long-term returns. So here's the strategy. Keep investing in the regular S&P 500, but reduce your overall allocation. Instead of putting, say, 80% of your portfolio in the S&P 500, maybe drop it to 50% or 60%. But you're not putting all your eggs in one basket. So where does that extra 20–30% go? Here's a question for you. Which country will dominate the stock market over the next 20 years? If you said America, you might be right. But history suggests probably not. In 1900, the United Kingdom was the undisputed global superpower. British companies made up about 24% of the entire world stock market. That Britain would remain the dominant economic force for the next century. But that's not how history played out. Fast forward to the 1980s, Japan was absolutely crushing it. Everyone thought Japan was the future. But then, the Japanese asset bubble burst. And America bounced back. Big time. America dominated the next 30 years. No country stays on top forever. The only thing that's truly certain in markets is uncertainty. And that's exactly why putting all your money in one country, even America, is risky. When you only invest in the S&P 500, you completely miss out on companies like TSMC, Samsung, Toyota, Tencent, Nestle, ASML. These are massive global companies, but they're excluded from the S&P 500 purely because of where their headquarters are located. It's simpler than you might think. There's a fund called VWRP. This single fund gives you exposure to around 3,700 to 3,800 companies spread across more than 45 countries. The whole world in one fund. And here's the beautiful part. It automatically rebalances based on market performance. You don't have to predict the future. You just own a piece of the entire global economy. The expense ratio, just 0.22%. That means for every £1,000 you invest, you pay 2.20 per year in fees. You can buy VWRP through pretty much any UK broker, trading 2112, Vanguard, Hargreaves Lansdown, Interactive Investor. And if you're investing through a stocks and shares ISA, which you absolutely should be, all your gains are completely tax-free. So here's what your portfolio might look like so far. 50–60% in an S&P 500 fund, 30–40% in a global fund like VWRP. Already, you've significantly reduced your concentration risk. Here's one of the best pieces of investment advice I've ever heard. You don't get rich by following the crowd. You get rich by being early. Think of the stock market like a grid with 4 different zones. Top right corner, the crowded zone. Nvidia, Tesla, Meta, Microsoft. Everyone's already invested here. Bottom right corner, the defensive zone. McDonald's, Walmart, Coca-Cola. These are businesses people rely on no matter what the economy is doing. Top left corner, the speculative zone. Beyond Meat, Peloton, AMC. It's closer to gambling than investing. But then there's the bottom left corner, the overlooked zone. Small to medium-sized companies with reasonable valuations. And this is where I think there's enormous opportunity right now. All those massive AI companies in the crowded zone, they're all making the same bet that whoever spends the most money building the best AI model will win everything. But what if that assumption is wrong? Smaller companies and startups are building software that lets users choose between different AI models. These AI models are getting closer and closer in capability. So what becomes the deciding factor? Price. Think about it like petrol. One petrol station sells fuel for £1.50 per litre. Another sells premium fuel for £3 per litre. But is it twice as good? For most people, no. This is what economists call commoditization. The value doesn't stay with the companies that spent billions building the technology. It flows to the companies that use the technology in the smartest, most efficient way. Cloud computing is a perfect example. Amazon, Microsoft, and Google spent billions building cloud infrastructure. But thousands of smaller companies used that infrastructure to build innovative products. Netflix, Spotify, Zoom, Shopify. The same thing could happen with AI through small cap and mid cap funds. In the UK, you can look for funds like Vanguard Global Small Cap Index Fund, iShares MSCI World Small Cap UCITS ETF, Fidelity Global Special Situations Fund, but allocating maybe 10–15% of your portfolio to this area could give you exposure to the next generation of winners. So now your portfolio might look like 50% S&P 500, 30% Global Fund VWRP, 10–15% small and mid-cap funds. Let's talk about gold. Now I know what some of you are thinking. Gold? Really? Isn't that old-fashioned? But here's what you need to understand. Every major leap in technology creates opportunity, but it also creates instability. And throughout history, when systems become unstable, gold becomes valuable. Central banks around the world are buying gold at record levels. China has been aggressively increasing its gold reserves. They've created something called the gold corridor. For the first time since 1996, gold has overtaken US Treasury bonds as the world's largest foreign reserve asset held by central banks, because the rules around gold have changed. Gold has been reclassified as a Basel III Tier 1 asset. Banks can now treat gold the same way they treat cash on their balance sheets. This is huge. The Bank of America has published new guidelines saying that financial institutions should hold around 30% of their reserves in gold, up from the traditional 20%. And here's the thing about gold: you can't print more of it. When demand goes up and supply stays the same, prices rise. When central banks, sovereign wealth funds, and major financial institutions are all moving in the same direction, it's worth paying attention. So how do you actually invest in gold from the UK? There are two main approaches. Option 1, physical gold. The Royal Mint sells gold coins and bars. Bullion Vault and Goldcore are other reputable options. Option 2, gold ETFs. This is usually the simpler option for most people. Look for funds like iShares Physical Gold ETC, Invesco Physical Gold ETC, Wisdom Tree Physical Gold. And if you hold them in a stocks and shares ISA, the gains are tax-free. Most financial advisors suggest somewhere between 5–10% of your portfolio. It's meant to be insurance, a hedge against instability. So now your portfolio might look like 45–50% S&P 500, 30% Global Fund, 10–15% small and mid-cap, 5–10% gold. Here's the biggest mistake I see young investors make: not keeping enough cash. And then life happens. Suddenly, they're forced to sell their investments at the worst possible time. This is why cash reserves are absolutely critical. You need a buffer. Most financial experts recommend keeping 3 to 6 months of expenses in cash. Warren Buffett, the most successful investor of all time, currently has hundreds of billions in cash and cash equivalents. He only buys when the price makes sense, and when the market crashes, and it always does eventually, he has the cash to buy incredible companies at bargain prices. This is the power of cash. It's not just about protection, it's about opportunity. In the UK, you have several good options. Easy access savings accounts. Look for accounts offering 4–5% interest. Cash ISAs. Similar to easy access accounts, but the interest is tax-free. Premium bonds, government-backed. Your money is 100% safe and accessible. The key is, keep this money separate from your investments. So here's what your complete portfolio might look like. Investments within a stocks and shares ISA, 45-50% S&P 500 index fund, 30% global fund VWRP, 10-15% small and mid-cap funds, 5-10% gold ETF. Cash reserves, 3-6 months expenses in easy access savings or cash ISA. This is a balanced, diversified portfolio. All right, let's bring this all together. But understanding isn't enough. You need to take action. So here's your step-by-step action plan. Step 1. Open a stocks and shares ISA. Choose a broker, Trading 212, Vanguard, Hargreaves Lansdown, or Interactive Investor. But don't overthink it. Just pick one and get started. Step 2. Build your cash reserves first. Make sure you have 3-6 months of expenses in an easy access savings account. Step 3. Set up regular investments. Set up automatic monthly investments, whatever you can afford. The amount doesn't matter as much as the consistency. Step 4. Allocate across your chosen funds. 45-50% into an S&P 500 fund, 30% into VWRP, 10-15% into a small or mid-cap fund, 5-10% into a gold ETF. Step 5. Review quarterly, rebalance annually. Once a year, rebalance back to your target allocations. This forces you to sell high and buy low. Step 6. Increase contributions as your income grows. Step 7. Stay educated. Keep learning, but don't let information overload stop you from taking action. Done is better than perfect. Start now, not next month. Not when you have more money. Not when you understand everything. Now. Because here's the truth. Time in the market beats timing the market. The best time to start investing was 10 years ago. The second best time is today. By following the strategy we've outlined today, you're positioning yourself to benefit from the growth while protecting yourself from the potential downsides. Look, I know this was a lot of information, and if you're feeling a bit overwhelmed, that's completely normal. You don't have to do everything at once. Start with step 1. Open that ISA, one step at a time. Before you know it, you'll have built something powerful. Wealth isn't built overnight. It's built through consistent, intelligent action over time. And you've just taken the first step by watching this video. If you found this helpful, I'd really appreciate a like. And if you want more content on building wealth, investing smartly, and navigating this AI-driven economy, hit that subscribe button. I'll see you in the next one. Now go take action. Your future self will thank you.